Hello, let's now walk through proposal 2. So we have dealt with proposal 1, which is immediate liquidation. Now for proposal 2, a reconstruction in which business associates of the directors would subscribe 40,000 Ghana cedi in cash for new shares in the company. From this cash, the preferential payables would be satisfied. The conditions are that non-preferential payables, including Adom Limited and the bank, agree to a reduction in their claims to 90% of the amount presently due. That payment is postponed for 1 year and the interest during the year is waived. So, the second proposal will require that there will be new capital injection. So we'll receive cash and increase share capital. Then we'll use that to pay the preferential payables. Apart from that, those that are non-preferential will reduce their claim to 90%, which means we will write off 10%. We will write off 10%. Now, in dealing with this, remember there is debt that will not be receivable. So a debt that is going bad or that will go bad. And then there is also the contract receivables that will also not be realized. I just want you to note that from the existing shareholders of Brady Limited are prepared to cooperate in the issue of shares under either of proposal 2 or 3, and that those proposals, bad debt, and valueless contract will be written off, and preferential payables will be paid immediately. So when we are dealing with proposal 2, we must take care of the bad debt and the valueless contract, the inventory, and we must also pay the preferentials. Then bank overdraft will be frozen, which means we'll have the overdraft. When we issue the new shares, we will not debit the bank overdraft. We will open a new account, a new bank account for subsequent transactions. So that's what we are doing with proposal 2 and 3. So in 2 and 3, we have to take note of that. Now, let's see the journal entries. So just a quick reminder, there will be new issue of shares for 40,000, out of which we will pay the preferential payments. Then we'll have to write off the bad debt and the valueless inventory and contract in progress. Then we'll also write down 10% of the remaining claim, which means we'll write off 10% of the bank overdraft, 10% of the other payables, and 10% of the bank loan. We'll write off those. And so that is what will guide proposal 2. Let's see how that will look. So proposal 2. First, there will be capital injection of 40,000. So we debit cash or bank and we credit share capital, new shares. Then we will pay the preferential payments. Taxation is 15,000, payables 9,000, and we will credit cash. So the cash of 40,000 will be reduced by the 24,000. You take note of that. Then remember, we'll write off the inventory and contract in progress of 50,000. It will be written off. We will write off the bad debt of the receivable, 41,000. That is a total of 91,000 to capital reduction. And then we are writing down 10% of the loan, the payable, and overdraft. So 10% is what is giving us this. It's a total of 25,000 we are writing now, which will give us 25,000 to capital reconstruction. So again, you will notice that we will debit capital reconstruction with 91,000 and we will credit capital reconstruction with 25,000. So we'll have to strike the difference. That difference between the two. Let's check the difference. We have debit of 91 and the credit of 25. So we have 66,000 debit on the capital reconstruction because the debit side is 91,000. And therefore, this 66,000, because it is a debit balance, we cannot leave it on the capital reconstruction. By rule, it is the credit balances that will be maintained as capital reserve. But this is a debit balance. The 66,000 is a debit balance, and therefore we write it off against equity. We write it off against equity. Now take note that you have two equity items. You have two equity items in the question. Let's confirm that. You have two equity items, the stated capital of 60,000 and the income surplus of 21,000. So if you are going to write off, remember the capital is the last um, equity item you touch. Capital is the most difficult item to touch. You don't just get up and touch capital. You must have a reason, and we have a reason this time. We are reconstructing our whole capital base. So these two equity item, income surplus is 21,000. So we write off 21,000 against the 66. So we are holding 66. We are holding 66,000 from the capital reconstruction account. Debit. A debit of 66,000 from the capital reconstruction account. We are saying these debits must be written off, and therefore we write it off against the income surplus. Income surplus has 21,000. It is less than 66, and then the balance will be written off against the stated capital. It will be written off against the stated capital. So 21,000 from 66 will be left with 45,000. So we'll take 45,000 out of the stated capital and 21,000 out of income surplus, and it will write off the 66,000 debit we have on the capital reconstruction. So there, your double entry. We are writing off 21,000 against income surplus, and then we are writing off the balance of 45,000 against capital, share capital, and then that reduces the capital reduction or reconstruction account, 66,000. So at this point, our capital reconstruction account is zero, zero, zero. Remember, we don't keep the balance. We don't keep an account called capital reconstruction in the books. It's a temporary account. So at the end of the day, we write it off. If it were a credit balance, we will transfer the credit balance to a capital reserve and we'll keep it there. And if it is a debit balance, we write it off because we can't do the reconstruction and still have debit on the reconstruction account. So that is it. Now, after that, then you prepare the revised statement of the financial position after the proposal. Now, remember, we did not touch plant and equipment, so it's there. Inventory, we reduce by 50,000. The 50,000 that will be worthless. Receivable, bad debt of 41,000. Cash, we received cash of 40,000 through new issue of shares and is reduced by the 24,000 to the preferential payment, so we are left with 16,000. So that's our total asset. When it comes to capital, the book value of capital is 60,000. We issued new shares 40,000, and we reduce capital by writing the capital reduction debit against it of 45,000. So we are left with 55. When it comes to liability, we have reduced the liabilities, the other liabilities, by 10% to 90%. So what we have here is now 90%. So the 30,000 becomes 27, 160 becomes 144, 60 becomes 56. We have reduced them and therefore we balance. So that is it for proposal number 2. Again, take your time, study, work through the questions. I'll be back with proposal number 3. I'm keeping it short so you don't feel bored watching, because I really want you to watch. Thank you.